Let's get into it with Bill Baruch, joining us this morning from Blue Line Futures to help us take a deeper dive into the top stories, what's on the minds of traders this morning ahead of the open. Bill, welcome. Good to have you here to help us get things started. I want to begin very broadly with, well, when you got up this morning, this Thursday, when you turned on your trading platform, what stood out? Anything you're seeing this morning that gets your heart pumping?
Well, you just mentioned that news with the U.S. strike, but markets aren't reacting at all, really, to it. It's sort of just, it's almost as if expected at this moment. You're seeing the treasuries back down a bit, yields kind of edging higher. Gold doesn't care. The stock market's really hanging in. And I think all things considered, the one that stands out most is just how well the stock market is consolidating and digesting these gains. Massive volume last week. The Marty Zweig breadth thrust on Friday, which is a rare moment. I mean, that happened March 31st. Last time before March 31st was January 7th, 2019. We all know how 2019 turned out. So I think all things considered, this is a digestion from the reversal last week in equity markets, and they're holding really, really well looking at these indexes, and it's a beautiful thing to see.
Bill, that kind of feeds into what we were talking about yesterday. I'm sure you're familiar with the old trading floor adage, the old industry saying, right? The cliche, don't short a dull market. We talked about that. The strong rally we saw last week after Fed Chair Jerome Powell, the FOMC decision, the jobs report Friday, and how we've just been kind of grinding higher this week amidst that lull. But I wanted to raise the flip side of that coin today, the other side of that discussion. And I mean, I'm going to pull the charts in just a minute here, but we're still holding below the October highs, which is up around 44.30. One could argue this is a bear cat bounce, or I'm sorry, a dead cat bounce.
I mean, this is a bull market. I mean, I think it's been a bull market. We're basically heading, starting year two. Some may consider starting year two, maybe at the turn of the calendar year. So I mean, right now, I think we're in a bull market, and I think the uptrend is here. Now, so a couple of things I'm looking at. Yes, 4,400 to 4,403 in the E-mini S&P futures is a huge level. There's a gap there. There's a retracement there. We really got to close out above there, and not just by a couple points. I want to see a decisive closeout above there. I think that's something that's pretty interesting to watch here today. The NASDAQ is trying to violate and really significantly get out above a downtrend line. And then the other one here is the Russell 2000. And the way I'm looking at that, this pullback from the big rip that Russell 2000 had is actually building out the right shoulder of an inverse head and shoulders right at the 21-day moving average. So the way I'm playing it, in the CTA, it's a commodity trading advisor program that I do run. We've been long the micro NASDAQs. I'm just going to sit with those. I'm not looking to trade them. I'm looking at 16,000. So I'm going to hold that position, and I'm playing a more of a tradable range with the Russell 2000. I'm using options there. I think those options can really pick up some juice when the market when that thing starts to rip. You look at from the price perspective, it's half the size of the S&P, but some of these days can be 40 points. Now, some of that's priced into the vol, but ultimately, if you get a good two-day run in Russell 2000 options that the CME has, is very liquid. I mean, those things are a great tool to utilize.
Bill, we've been keeping a close eye on the Russell. I'm glad you brought that into the discussion here today, because it has been a bit of an outlier, right? Holding below the 200, holding below the 50-day moving average. We just looked at your chart as you were talking about it. Here I want to bring to our viewers' attention what I mentioned, the big move up last week in the S&Ps. We've got it from 41.22 a couple Fridays ago into that jobs report last week, and how we've just been kind of grinding higher, right? Up and through 43.80, up and through 4,400 overnight. We topped out here at 44.10, but taking a look as we step away from the 30-minute candle chart and look at the last, 5, 6, 7, I guess, 8 now trading days of price activity, you can see this rally here. Again, almost 10 days now, but rechasing that whole move that we saw throughout the month of October, lower from 44.40 down to 41.20. And again, here you can see Bill still holding below that October high. I just want to point to here, crude oil, because to your point earlier, I mean, you've got the geopolitical tensions going on, potential for a broadening of that situation, which, don't get me wrong, no one wants to see, but very much still being all taken in stride in terms of energy markets and the broader market in general, one could argue.
Yeah, I mean, absolutely. You're ultimately seeing the war premium come out of gold, come out of crude oil. I mean, crude oil is trading somewhat recessionary-like. So I think that is a bit of a concern. I also think that's more technical of a breakdown. So, I think there's some positive comments I've seen here through on the Twitter feeds this morning from OPEC. I mean, obviously they've been jawboning a little bit this week, but positive comments of demand coming out of Asia. We've also seen Goldman Sachs raise the GDP numbers expectations for China this year too. That came out this morning as well. So inflation data last night from China in line. PPI though was a little bit better or less worse than expected. But the data, that's really what's going to start to pick up here coming out of China the next couple of days. New loans data I think is scheduled early tomorrow morning, and then we get some some of that fixed asset investment industrial production early next week. So there's a lot of data coming out of China. I think that's going to be really important for crude oil. Obviously a big liquidation down there, and yeah, these markets are really trading. They had the reaction to the onset of the war, so to speak, and really right here it's just taking it in stride. I mean, I think you've said it. Even though things are slightly broadening geopolitically, the markets don't seem to care too much right now. But let's see how that looks going into the weekend, though. With people being shut out from the market.
Yeah, I mean, obviously uncertainty into a Friday afternoon, especially if the heat were to continue or the boiling were to continue here into Friday. But we just recently rejected a key level up around 95, so that coincided with the highs that we saw back in October, November of last year as well. So coming off that, back down below the 50-day moving average, and again taking it all in stride. Many could argue in terms of the fact that we're very much range bound here. And I look at price activity, a reflection of the fundamentals in many ways, right? You were breaking it down. China, which for the most part has been a bit of a disappointment. That's kind of bearish price. Geopoliticals have in many ways probably kept things somewhat supported in this area here, right? That's somewhat bullish. But then you've got China, which, again, that tug of war between disappointing news out of China and the geopolitics kind of have price sideways. And then China, even in itself, has a little bit of a tug of war, as you pointed to some of the data recently. CPI overnight coming in down 0.1%. I saw, I think it was pork prices, which had spiked there ultimately. But talk to us, because as we look for crude or to crude for some direction at this point, I mean, it really hasn't been providing us that. But one could argue the fact that we haven't seen the level 95 taken out, that's kind of the line in the sand in terms of that pain threshold, many would argue, and possibly a headwind for stocks should we get above it.
Yeah, I mean, I think right now, I think there's, one of the main focuses here in crude oil, and it's just, it's not, you can't put an exact number on it, but here's the thing. I mean, we know we're going into an election year. We know the administration doesn't want to see higher energy costs. We've seen gasoline come down significantly. Yep. We're heading into the winter right now as well. Distillates, heating oil, they've come off as well. So, I think right now, I mean, there's a little bit of a political game potentially here. The White House has talked about restocking the SPR. Are they going to do that now that we're significantly below $80? I don't know. So there's some stuff here that could become a catalyst. The EIA didn't release data this week as well. We'll get a deluge of data next week. From the weekly petroleum report. So a lot of this is going to work into that. There really hasn't been a catalyst outside of geopolitics this week, but I'm surprised to see somewhat a muted reaction from Goldman Sachs raising their China expectations in GDP. But we are kind of just battling. We went below the 200-day moving average, kind of battling. Let's call it at the 200-day moving average until we really kind of close below it on a weekly basis. So I think it's a liquidation. I mean, who really, without a catalyst and the fact we couldn't follow through, ultimately why people that were looking for that hope that we're going to get that ultimate break above 95 with geopolitics being the catalyst, they're stepping aside, and that's really brought this thing down.
Bill, I want to pull a couple charts here to your point, and I'm glad you brought RBOB into the discussion here, because here we have crude oil, which has been coming off, again, that 95 level, and here's that area I referenced a minute ago, the highs from last fall, October, November last year. And as we take a look now, to bring in crude oil on the left, RBOB on the right, RBOB to an 11-month low as we trade back down below 220 here, back to levels we haven't seen since the beginning of the year. So keeping an eye on as prices at the pump here in many ways have been somewhat appeasing to the bulls here in many ways. Let's talk about some of the eco data. Speaking of appeasing to the bulls, that non-farm payrolls number last week, and today we'll get a look at the jobless numbers, the weekly claims.
Yeah, we'll see that jobless claims. I have to believe we're going to start to edge a bit higher. I mean, especially if you're looking at how gasoline's trading, you look at how some of these energies trading recessionary, like a global recession, so to speak. But I mean, I would have to think that we're going to start to see jobless claims start to tick back up. Some of that could be coming out, there's a delay coming out of the summer. When the kids go back to school, people start looking for those jobs. They're not traveling. So there might be a bit of a increase in the jobless claims. We got a lot of Fed speak today, too. I'm looking forward to seeing what Bostic says. That spike to 44.10 in the S&P was from the Chicago Fed President Goolsbee early this morning. He said some dovish comments. Bostic has been, somewhat dovish recently. Then we get comments from Powell later today. So a lot to really digest. And then tomorrow is the Michigan consumer data, which the one-year inflation expectations have actually continued to rise. And I think taking what Fed Chair Powell said last week, really the risks of doing too much and too little are now balanced. And he also did talk about inflation expectations being anchored. And I thought that was a positive for the markets because I didn't see the inflation expectations as being so anchored right now. If you look at that in Michigan consumer inflation expectation for 1 year went up to 4.2% in October. It was expected to be at 3.4. Initially came in at 3.8 in the first read, and then went to 4.2. I'm really looking to see what that comes into tomorrow. Does it start to back off on the first look at November? Because Fed Chair Powell has said many times this year that inflation expectations are a self-fulfilling prophecy. And the most easiest way to look at it, if gasoline's going to be 50 cents higher next week, you're going to go fill your tank up right now. It drives demand. So I think that's a really important number to watch tomorrow and really keep a real close pulse on.
The Fed will continue to watch sentiment as well. And Bill, always appreciate joining us, especially this morning, to help us get things started here on the Future Show. Bill Baruch.